Good evening, and thank you for joining us today as we discuss group practice formation. My name is Keith Dreyer, Vice President and General Manager of Schools, Staffing, and Transitions with Henry Schein, and I'm fortunate to be your moderator this evening, or this afternoon on the West Coast. We're really appreciative that we have attorneys Bill Barrett and Casey Gocel with us today. Bill is the CEO of Mandelbaum Salsberg and co-chair of the National Dental Law Center. Bill is recognized nationally as a transactional lawyer in dental and medical practice transitions, practice sales and purchases, associate buy-ins, startups, and the structuring of DSOs and MSOs. He provides strategic advice to companies of all sizes, from formation to dissolution and every stage in between. Casey is a partner at Mandelbaum Salsberg, who specializes in corporate transactions and estate planning. Casey's clients include small and middle market companies and executive employees, often in the field of dentistry. She advises clients on issues concerning contract negotiation and drafting, mergers and acquisitions, strategic tax planning, choice of entity, general commercial relationships, complex buy-sell arrangements, succession planning, and other legal matters. Before we begin, I'd like to remind everybody that tonight's webinar is being recorded and everyone will receive the link of the recording in the next week. If you have questions for the speakers, please type them into the Q&A box and we will answer them live at the end of the presentation. This webinar is presented by the Henry Schein Dental Business Institute, and no CE credits are being offered this evening. It's a pleasure, and I would now like to turn it over to our speakers. Bill, Casey?
Thanks, Keith. Appreciate the introduction. It's great to be with everybody tonight. And for those who are going to be watching this afterward, talking about group practice formation. And, when we talk about group practice formation, I think what it comes down to, for me at least, and I think for most of our clients, is the preservation of private practice dentistry. By preservation of private practice dentistry, what I mean is figuring out where the world is potentially going. When we look at why is it that there are more and more DSOs and corporate dentistry happening, and part of that is identifying what the consumer wants. And I think that when you look at why group practice is growing and more we see the development of group practice, is because people have figured out that there are benefits to economies of scale. How do you maximize fixed overhead, right? In most businesses, the rent is the rent or the mortgage is the mortgage. Insurance is what it is. And when we add more top line revenue, a lot of times it really doesn't require a lot of additional spending in terms of overhead, because overhead is a relatively fixed number. And the consumer has showed us that they want great technology. They want flexible days, flexible hours, being able to see general dentists or specialists in the same location, acceptance of most insurance. So these are the drivers, at least from what we see from our clients, in a movement towards more and more group practice. So where are we now, right, in the terms of this marketplace? You may have noticed there's been some unusual things going on during the last 7 months, and it hasn't been exactly normal, has it? For us as lawyers as well, I think about reflecting upon the last 7 months throughout my career and 22 years of representing dentists all over the United States. I think about the things that we had to experience in a short period of time, like office closures, clients looking for advice on how do I close my office the right way, or how do I furlough people, and what's an EIDL loan and a PPP loan, and how do I apply for them, and okay, great, now how do I reopen my office and protect my staff and my patients and comply with employment laws, and what if somebody gets sick, or what if a patient gets sick? I took loans out. How do I get loan forgiveness? I mean, this has been quite a time during the last 7 months. But one of the things that has also come out of this, and this goes directly to the issue of expanding and growing in group practice, is we've seen unprecedented activity in mergers and acquisitions. And right now we are, and as I said, I've been doing this for 22 years, and our transition practice working nationwide, we have more transactions going on right now than at any time in our history. And I think there's a lot of reasons for that. The move towards growth, consolidation, group practice was already happening, but I think that in many respects, the pandemic itself has kind of turbocharged the process, and at least that's what we see. And right now, our clients who were well positioned, who were growing, doing well, we find that those clients are continuing to do well. And those who were at different stages of their career, maybe they were getting ready for a transition already, or they were at a point of their career where maybe they didn't want to make certain investments they'd have to make in this post-COVID world, have not only resulted in more sellers and excellent practices that are available in the marketplace, but motivated parties that are more accepting of alternative business structures, which we'll talk a little bit about as we move through the discussion. And, and throughout all this, bank financing has remained strong and available to buyers who are looking to grow and expand. So it's been a crazy time, but, often in life and in business with crisis comes opportunity. And I think that right now, in terms of this, current state of the marketplace and the future, I think it's very bright, and that M&A is going to be very active going forward. So, Case, do you want to kick off here with establishing your team?
Sure, I'd love to. So for those of you who don't know, Bill and I actually wrote a book together last year. Actually, today's October 1st, right?
It is.
Today's the 1-year anniversary of the day we launched the book. How about that? That's good timing. So thank you all for coming to our 1-year anniversary party. So our book is called Buy, Sell, Merge, and it's written for entrepreneurial dentists. And right at the beginning of the book, we start with this chapter on establishing your team. We start the book with that because it really is sort of the kickoff point of growing your practices. And arguably, I would say probably the most important member of your team, even more important than your attorney, maybe, is your accountant. And the reason I say this is because, the finances and the bookkeeping is sort of the basis of the entire enterprise, and making sure that that's done in a proper way is so important. And I can't even tell you how many times we begin due diligence when we're looking at a new practice and we open up the books and records and the profit and loss statements and we just see a mess. People may have the best of intentions, but hiring your next door neighbor to be your accountant just because he had some experience is not necessarily the best way to grow a dental enterprise. So when you're looking for an accountant or reevaluating who your accountant currently is, you want to be looking for someone who specializes in dental, somebody who has a large population of dental clients, somebody that's referred to you by another dentist, and can really speak the language and can manage your books and records the way that they need to be done in the dental context. That's probably the most important player as far as starting off.
And can I add on to that too?
Yeah, sure.
While you're on accountants, for those who are watching and either already in group practice or they're thinking about growth, multiple locations, wherever they're at, it's important too when you vet your accountant. Not only are they, experienced in our profession in dentistry, but they have experience with multi-practice location operators or group practices. You don't want to be the first group practice and larger or growing organization that they've represented. So I just wanted to make that little footnote that when you go through the process of vetting someone out, make sure you ask the questions about the types of practices that they represent.
And I think that what you'll find is, the dental community, even on a national scale, is a pretty small community. We're a close-knit community, and there's only a handful of people that specialize in dental, be it accountants, attorneys, brokers, bankers, even, and insurance professionals. Working with people that specialize in the dental space is going to make a world of difference. So obviously, when you're looking for an attorney to work with, you don't want to pick someone who just knows about litigation or real estate law. You want to pick somebody who's got experience with representing dental practice owners. There's tons of brokers out there that sell all sorts of different kinds of businesses. So when you're looking for a broker to help you find a new practice, again, you want to make sure that you're working with a broker who specifically is specialized in dentistry. These are the people who speak your language. They understand your industry. You'll save a lot of time and a lot of money just choosing to work with people who understand the industry. And obviously, we've got a list here of other specialized players, practice management consultants, insurance professionals, bankers. And if I'll just touch on that for a second, in this post-COVID world, we've been working with a lot of banks. Our M&A practice is the busiest it's ever been in my entire career. I don't know, Bill, probably yours too. We're closing deals instead of on a weekly basis. We're closing multiple deals on a daily basis. In fact, we closed 2 today and another one tomorrow. But a lot of these deals, they involve bank financing. And if you go out and try and work with a lender who doesn't specialize in dental, you'll be hard pressed to close a transaction right now. Even the dental specialty lenders are having a hard time closing transactions just because they're trying to verify financials and make sure that, post-COVID, the practice is performing at the level that they're looking for. So again, whether it's borrowing money, finding a practice, looking for insurance, looking for an accountant, please do yourself a favor. Look for somebody who's specialized. And if you don't know somebody, ask around, ask somebody at Henry Schein, ask one of us. We're happy to make referrals. It's a pretty close-knit community. Anything else to add on that point, Bill?
No, I think you covered it well.
All right, great. Well, let's talk about practice acquisitions.
Okay.
So
go ahead.
Do you want me to kick it off and then you can... Okay. So obviously the first step in acquiring a practice is to find that practice. And there's a couple of different things to think about when you're talking about expanding your current business, your current practice. The first question is, what kind of practice are you looking for? Are you a specialist looking to only buy specialized practices? Are you a general dentist looking to acquire specialties so that you have sort of a network that you've built your own? We have represented people in all sorts of industries throughout dentistry, and they all do it a little bit differently. We've got a great client in the Connecticut market who is a specialist, but he only buys general practices because those practices then refer to his specialty practice. We represent a number of oral surgeons who only will buy oral surgery practices. So you need to kind of be thinking about your end game and what you're looking to do and whether or not you're willing to branch out of what you're used to. So general versus specialty is one thing to consider. Another thing to consider is the location of the practice. Obviously, you're restricted to where you're licensed, so you can't really go out of your licensed territory unless you're willing to get licensed in another state. But, do you want to stay within a specific county or a specific demographic or a specific area? We are representing someone right now who is located in the Massachusetts market and is now moving into New Jersey. So he has to get licensed to do that because he really wants to expand. Other people, they only want to work in their own backyard. They know the referral source is there and they're comfortable there. So the where after the what kind is another thing to consider. And, when you're talking about the location, you also have to be mindful of where your practices are located in conjunction to one another. You don't want to be competing with yourself. We represent a practice right now they just closed on 2 deals in the past month. And they asked me to prepare an LOI for a third practice, and it's in the same exact town. and they're a specialist. So I happen to say to the client, you're competing with yourself at this point. Like, there's nobody else in this market. Do you really want to spend extra money to compete with yourself just to have another location, have more overhead? It's another lease. So we ended up deciding to forgo that one, and we're going to look in the next county over. So that's just another thing to think about when it comes to finding a practice. And then you might be thinking, like, how do I locate these people? Well, as I mentioned before, there's tons of specialized brokers out there that can help you. I'm sorry, I shouldn't even say there's tons of brokers out there that will try to help you locate practices. But, be mindful of the fact that a broker who doesn't specialize in dentistry isn't going to know what you're talking about. So, Henry Schein, perfect example. They are a national broker. They understand the marketplace. They probably understand your specific area. These are the kinds of people that you want to be working with when it comes to finding a location. Bill, you have anything you want to add?
Yeah, just a tag on there too that, working through your network is very valuable in terms of your professional network. And sometimes you can also, stumble upon an opportunity with a practice, whether it's through your study club, through professionals that you work with, like accountants, lawyers who maybe have a lot of representation of people in the industry. The other thing too is when looking to acquire, culture, fit, and philosophy is a very big deal. You really want to make sure that you are, I always say to people that getting into group practice and multiple locations, potentially multiple partners, it's not unlike a marriage. And when it goes well, it's great, but if it goes poorly, it can be a lot like a divorce. So understanding and having the same culture, fit, and philosophy about how you practice and how you manage people and, is very important as part of your overall due diligence. A lot of times when people think about due diligence, they right away just think about the economics, which of course is very important. But there's a lot of aspects to due diligence. There's legal due diligence in terms of understanding, does the target practice have contracts in place for its associates with adequate restrictions or covenants to protect the practice going forward? Do they follow and comply with employment laws? A very simple example is, there's a lot of abuse that takes place nationally in the classification of independent contractors versus employees. That's part of the legal due diligence aspect and very important. So you have your financial diligence, you have your legal diligence, but you also have your human intelligence diligence, which is very, very important, as well as the quality and caliber of the dentistry being performed. So a lot of times, we recommend different questions to be asked during a process of vetting. And even a lot of times you can learn a lot about dentistry by talking to staff members and getting ideas on, how often do people come back for recall or redo appointments. So due diligence is broad in scope, and there's the important component too on culture, fit, and philosophy, because you want to make sure that you've got the right target.
So the next thing that we're going to be talking about is deal structure. And there's a couple of different ways that you can structure an acquisition. So I think the one that's sort of the plain vanilla, the standard out there is that you go out, you make an offer, it's a cash deal, and you pay 100% of the purchase price at closing. And that is financed either through your personal assets or through a bank. That's pretty much the way it used to always be done. Now we've been seeing a lot more creativity these days, right, Bill?
We have, but pausing there for a second on standard purchases. You alluded to it earlier, and I think it was an important point that you made, which is while financing is, we're seeing is still very robust and deals are getting done. The underwriting process has definitely tightened. Underwriting takes longer, so you should, allocate time, to make sure that what used to take maybe, I could get an answer on a deal from a specialty lender in a week or so previously. I mean, I just had a transaction that ultimately got approved, but it took about 6 weeks to get through the underwriting process. I also had one where we got to about the 6-week point and the deal didn't get approved. So, it's important to just understand that in this new world that we're living in, while it's still, readily available and the lenders want to do business, the process can be a little bit difficult. You've got to deal with the COVID issues in terms of there's a lot of analysis going into how has the practice recovered since COVID. And going back to that first slide, when Casey talked a lot about, what I like to call like your virtual board of directors, your team of professionals, I never underestimate the banking relationship and how important it is to have not just a lender, but a person. You want to have access to a banker, a decision maker, a loan officer, where there's a relationship there. It's really important. Like I always tell people, everything isn't about price or everything isn't about rate. To save a quarter point and do a transaction with a lender where you have absolutely no relationship, in my view, is not as valuable as an ongoing relationship, because when you really want to get things done, it's a tremendous advantage, in my view, to have a good banking relationship. But I just wanted to make that side note when we talk about standard deals, so people have a flavor for what's going on right now.
Agreed. And the next option, which we've been seeing a little bit more, is where the seller actually acts as the bank. This is known as seller financing. You want to talk a little bit about seller financing?
Yeah, I do, because, when we were just putting this together and putting the slides together for the presentation, I was thinking back, on my career, and, 22 years ago, it was pretty typical on a lot of deals where, the specialty lenders had not really exploded out there yet. And it was very typical that a doctor would hold the note when they sold their practice. In fact, more deals than not earlier in my career, that's the way you would structure them. There'd be a down payment, there'd be a promissory note, et cetera. And over the last, I would say 15 years, that actually became pretty rare. I mean, it was actually unusual, especially the last decade, very unusual to have seller finance deals. Sure, we have them, but they used to be all the time, and then they virtually disappeared. And what's interesting now with what's happened with the pandemic, we're seeing seller financing back pretty strong. When there are issues with the lending or the timing, certain practices that hadn't reopened yet that were being acquired and they wanted to get the acquisition done quickly, they went to a seller finance model and were able to close the transactions very fast because they didn't have to go through a bank approval process. So, it's interesting how timing and markets and the forces around us can sometimes change how we look at deals.
Yeah, and if I could also just add, there's a little bit of a tax component with the installment sale as well. So what many people miss is that there's an actual opportunity here for the seller to defer the recognition of the gain on the practice, because when they accept 100% of the purchase price in full on the day of the closing, because it's been bank financed, they're then going to pay 100% of the tax that's due on that gain in that first year. However, if we enter into an installment arrangement where the seller is actually going to act as the bank, you're going to sign a promissory note and you're going to make payments over several years. The standard is about 5, but we can do it all sorts of different ways. So the seller only has to recognize the gain on the amount of purchase price that it receives each year. So the seller is actually deferring the tax recognition. So there's a tax benefit to the seller, and that's why it's been pretty enticing to them. When we go to a seller these days and say, look, it's going to take us some time to get bank financing. We're not sure how it's going to work. would you be interested in seller financing? You'll get security, you'll get to keep the interest. And oh, by the way, you can defer your taxes. They get pretty excited about that. So that's just another important factor to think about. And then we have the combination of the two, which is actually probably the most prevalent that we've been seeing right now.
Yeah, I'll jump in there a little bit. So we have seen a number of deals where banks are willing to lend, but maybe not the 100% that they were willing to lend, prior to the pandemic. And in those cases, the seller might hold a smaller note, sometimes an equivalent note, or just a piece. And there's a couple of reasons for that. One is, the bank reduces some risk and the deal still gets done, because when there is a seller note and bank financing, that seller note becomes subordinate or junior to the bank financing, which basically just means that if there was, God forbid, a default, the bank gets paid first before the seller note gets paid at all. So there is some small, but there is some risk element there. But that's also something that kind of keeps some skin in the game also for the seller, and an ongoing interest in the success of the buyer in the transaction, because they still have money out there that hasn't been paid yet. So we are seeing some hybrids out there right now, which again, we didn't see a lot of in recent years, but now in the last 7 months, we've seen quite a few deals like this.
Yeah, Bill and I are actually working on a really interesting one right now, which is a hybrid concept, but it actually spans the practice and the real estate. So, we always tell our clients, if you have the opportunity to purchase the real estate of a practice, then go for it. For those of you who don't know the Ray Kroc story, he's the founder-ish of McDonald's. He wasn't the original founder, but he was the one that grew McDonald's and made most of his money actually off the real estate. But so many of our clients try to follow that model, and they're buying real estate. But in this particular case, we have a real estate issue that's not very clean. There's some zoning issues. The bank is not interested in it at all whatsoever, but our buyer really wants to buy the real estate. So what we're doing in that particular case is that we're getting bank financing, 100% bank financing to buy the practice, and then we're getting seller financing on the real estate. So we've had to get a little bit creative because of COVID, but there are definitely ways to close deals, and we're doing a lot of it right now. One last way that we've structured deals is this earnout concept. We write a pretty large chapter on this concept, I think, in our book, right, Bill?
We do.
Because, up until a couple of years ago, I'd never heard of it. We started doing it, and now we're seeing a little bit more of it. But you want to talk about the earnout concept?
Yeah. So the concept of earnouts has been very prevalent in mergers and acquisitions, for a very, very long time in traditional business. You didn't see it a lot in dentistry, really, and more we see more deals. But when bank financing was just so readily available and easy to get, underwriting was very easy pre-pandemic, earnouts would pop up here and there. There has been a little bit more acceptance on the part of sellers, especially sellers that are distressed or have or they're trying to seek out a purchase price that the numbers don't currently justify, or the lender looks at it and says, it's not worth the price that the seller's looking to get. We've also seen this in practices that didn't reopen. And now they're looking to do a transaction and maybe fold into another practice. And the concept of an earnout is really it's payment on performance on a going forward basis. So, for example, I'll make up a hypothetical, 15% of gross receipts from the patient base that's been acquired over a 5-year period. So, in essence, if the practice is successful and does well or grows, the purchase price ends up being more over time. Or if the practice doesn't do as well as it did historically, or doesn't grow, or maybe even does worse, the purchaser effectively paid the fair amount for it, because the earnout creates, in essence, asymmetric risk for the buyer. But on a practice where it does grow or it returns to its former glory, the seller is able to get paid more than they might have gotten had they just done a cash transaction. And there's all sorts of variations on this too. A lot of times we'll do an earnout, but there's a down payment component, which is very common, because the seller will sometimes have obligations. They've got to pay their brokerage commission, of course, like off the top at the closing, which has to be paid. They've got to maybe pay some debts that they might have, or they might have equipment leasing and so forth. So a lot of times we see earnout structured where there's a down payment by the buyer, and then the remainder is paid out based on future performance. So again, these deals that we've been doing them for a long time, and they would be onesies and twosies here and there. And during the pandemic, again, for some practices that have struggled to be able to go through a transition, this is a structure that we've seen spin out more and more, and has gotten a lot of deals that might not have closed, gotten them closed.
This is also a really good strategy where the former owner, so the seller, is planning to stay on as an associate post-closing, because if they're going to continue to work at the practice, they can sort of oversee and make sure that the revenue is coming in. So as long as you have a situation where you want that person to stay on for the full length of the earnout period, they normally get pretty excited about the idea that they can work a little harder and actually add to their bottom line by increasing the purchase price. So we find it's a win-win strategy for both the buyer and the seller, and people really like it. Okay, our next topic is when to take on a partner. And we really, are normally talking about taking on a partner in one of two contexts. Either we're talking about scaling the business and wanting to grow, or we're talking about succession planning and wanting to get the strategy on how we're going to retire and have somebody buy us out. I guess there's a couple of different ways that you can bring on a partner. And there's also a couple of different things to consider when bringing on a partner. So I guess maybe in the context of scaling your business, we talk about bringing on a partner in different satellite offices. So if you have your mothership practice, maybe you want to hang on to the whole thing because you're the main working dentist at that practice. But let's say that you're looking to expand and you're going to open, a second location or even a third location. You may not necessarily be able to oversee all these locations, and you need to have somebody else on your side who's not only going to work there, but also buy into this idea of growing the practice and making it profitable. And so that's a perfect opportunity to elevate a great associate who's got some entrepreneurial spirit to a minority owner in that particular location. Bill, you look like you have something to say.
Yeah, no, I just want to chime in there a little bit. Over the last 20 years, I've had some very, very successful multi-practice owners and group practice owners, and I've had some that have not been successful. And one of the things where they sometimes fall down is they have a really great primary practice that they've done very well and they've been successful at, and they want to now maybe get to another location and continue growing. And maybe on location number 2, now they're working like 3 days a week in one practice, 3 days a week in another. They're in essence stretching themselves and as a person. And they very quickly realize that is not a business plan. That's not how you scale. There's 7 days in a week. And the idea as an entrepreneurial dentist that's growing an enterprise, whether it be group practice, multi-practice location, is to properly scale the enterprise. As Casey said, you ultimately really need a working partner and on location that's vested. There's, of course, you can have some great associates and there's other ways to scale, but one of the best ways to scale is through a partnership, in particular a minority partnership, but having someone who has a vested interest in growing the location, working the location, being productive there, helping you manage people, very important aspect. So
Yeah,
that's one of the areas. And then the second area is the traditional concept of why to bring on a partner, which is succession planning.
Yeah, absolutely. And I just wanted to touch on something that you mentioned earlier, which was culture and philosophy. When you're talking about bringing on a minority partner or elevating one of your associates, whether it be within your practice or at one of these satellite offices, culture, philosophy, fit, personality, these are huge things. And Bill kind of talked about it a little bit earlier in the presentation, but this is a marriage of sorts. It's a business marriage, and you need to make sure that your vision is aligned and that, you have the appropriate end game in mind. Because if you enter into a relationship, as I'm sure many people have experienced before, with somebody who's, not the right fit for you, it's going to be a little bit of a disaster, even if they are entrepreneurial. So it's important, you're bringing somebody into the fold. You're giving them access to your books and records. You're putting them in front of your patients. You're allowing them to hold themselves out as a business owner under your brand name. And so, it has to be the right fit. So just kind of wanted to keep that in mind. And then the other thing I wanted to say on this topic was about, deciding how much of a percentage in your practice you're going to sell to somebody is also something worth considering. So in the context of succession planning, we often structure it in tiers. So maybe after, some form of courtship period where an associate's going to work for you for a period of time, maybe you offer them a 10% ownership interest in the practice. And maybe after another year, you offer them another 10%. And over time, you kind of let them build their equity in the practice as you get closer and closer to retirement. But what we always advise our clients and what we say repeatedly in the book is that you never want to make somebody an equal partner. You should always maintain a minimum of 51% of the ownership of the practice as long as you're planning to work there. Once you're ready to retire and step away, that's a different story. But until that time comes, you want to maintain control.
Yeah. And Kate, just to drop a footnote on that.
Yeah.
We're talking about that in the context of an entrepreneurial dentist who's trying to scale large scale with multiple locations.
Right.
As opposed, there are other scenarios where, and I know that Henry Schein does a very good job structuring 50-50 partnerships. And there are scenarios where that works very well. Our philosophy on someone who's trying to scale large scale is to try to have minority partnerships, because also if you grow the location big enough, you want to free up the possibility to have more than one partner at that location, depending on how large it grows. So there's a lot of different ways to look at it, but part and parcel is figuring out how much am I going to sell? What am I going to sell it for? Do I have the right, fit, culture fit, and philosophy, and so forth. So anyway, I didn't mean to interrupt you, but I just wanted to drop that.
No, absolutely. No problem. And, there's basically two primary documents that we advise our partners to enter into when you're bringing on a partner, when you're elevating an associate. One being the partnership agreement, which you may have heard referred to as an operating agreement if you're an LLC, a shareholders agreement if you're a corporation. Some people just call it a partnership agreement. Some people call it a buy-sell agreement. It's all the same thing. It's basically the document that's going to govern your relationship with this other person or other people. And then the second document is the employment agreement. And you may be thinking, I'm an owner, I don't need an employment agreement. But we typically recommend that when you're entering into a partnership, that all of the owners sign employment agreements. We've actually had a few pretty unfortunate situations where the idea was that we were going to have equal partners and everybody was going to work together towards the management and everybody was going to work at the practice, and it didn't actually work out that way. So it's important to have employment agreements that sort of spell out how are you going to get paid for the time that you're actually working as a dentist versus the amounts that you're going to get paid as your ownership. So Bill always likes to talk about there's 3 different ways to get paid as an owner of a practice. You want to talk about that?
Yeah. So, when people think about partnerships and group practice, they think about getting paid in accordance with their ownership interests. But you also have to figure out how to properly compensate people for their actual production, which is, to Casey's point, the importance of the employment agreement is to have an agreement on, what do we get paid for the dentistry we do? And then the third way, so you have your ownership, what we call the profit sharing, the production that you do as a working dentist. And then there's also, is someone assuming more of the managerial roles and in terms of managing the practice so that they get paid in essence as a CEO dentist, and all those things need to be established. One of the things Casey started alluding to that was a story that we actually mentioned in the book is also establishing in these partnerships minimum criteria for performance in order to retain equity. And we had a scenario where we had a 50-50 arrangement, and the vision was that this was going to be, two working partners putting in equal time. And the practice was a group practice, became wildly successful, making millions of dollars. And one of the partners was killing himself, working 6-7 days a week, not only as a dentist, but running the entire operation, doing all the work. And the other partner, same age, perfectly healthy, good capability, said, wow, my profit interest is so big that, I don't really want to go to work and do dentistry every day. I'm just going to clip my coupons and take my profits. And because they had never settled on minimum requirements or standards in order to retain equity, one partner was doing all the work and the other partner doing very little, going in like 1 day a week, but getting 50% of the profits. And it really is a great example of how a partnership agreement, or, as Casey said, the shareholders agreement or the operating agreement, depending on your business entity, if it has blind spots, the unforeseen consequences of those blind spots. I mean, everyone usually thinks about what happens if someone dies, becomes disabled, wants to withdraw from the practice. What happens then? How do you value those interests? All those things are built into a good agreement, or they should be built into a good agreement. But sometimes there's things like minimum standards that people don't really think about. And then down the road, it sets the practice up for potential dispute among partners. And, so you really have to put thought into how you structure these agreements and how the money is going to flow.
Yeah, and just to go back to the buy-sell terms that you were just speaking about, Bill, that's really where the succession planning comes in, because, buy-sell terms can be done a lot of different ways. And sort of the standard is that, upon one person's death or disability, the other one will buy them out. That's normally funded with insurance. But the question really becomes, what happens upon somebody's retirement? Is there an obligation to buy out your partner when they want to retire? And so when we're structuring a situation where you're going to be elevating an associate to sort of take over your practice, we often will write in, an optional retirement age. So once the senior doctor hits a certain age, he has the option to retire upon X amount of months of notice, upon which the junior associate is required to go out and get financing and cash that person out. So that's like an awesome way to set up your own little retirement plan right in your buy-sell agreement. Anything else to add on that, Bill?
No, I think you covered it. I mean, you could do a whole lecture on partnership agreements,
and we have.
and in the last 22 years, I could probably give you 30 great stories of phenomenal results, and give you a handful of stories with not so phenomenal results. So it's probably a subject matter all of itself, but I think that gives people a good flavor.
Yeah, absolutely. So Keith, we promised to keep our presentation to 45 minutes to allow for any comments or questions from your audience. So
great. Thank you, Casey. Thank you, Bill. Obviously, your years of experience show. You don't look it, but in a positive way. So we
at least Casey doesn't look it. I do.
So we do have a bunch of questions lined up in the queue. And actually, though, I'd like to use a little moderator prerogative. And can you talk about bank covenants? Because banks are doing deals, but a lot of our audience is on the buy side of buying practices tonight. And are you seeing a change in covenants from pre-COVID? Is there anything that buyers can negotiate with a bank on covenants? Do you help with that kind of negotiations? Any advice there?
Yeah, so I mean, I haven't seen much change in the loan documentation themselves, right? I think the big change or issue is the banks being much more selective in what they'll lend on and doing a much, not that they didn't do a deep dive before, they did, but I'm seeing it's a much deeper dive. They're not only looking at the practice that's the target and what it's doing post COVID, they're looking very carefully at, our client, and we have the majority of our clients are in acquisition mode as well. And they're looking at how have all their other practices or their locations recovered, and, do they cash flow? Are they meeting the debt service ratio? But, in terms of being able to negotiate loan documents, our experience is that the specialty lenders will not allow much in the way of modification. They have very standardized documents that we can get some changes negotiated into documents, but not a lot. However, when our clients have affiliated with community banks or regional banks that have healthcare divisions, those transactions, because a lot of times you're dealing directly with the decision maker versus a loan officer, and those transactions you tend to be able to make more comments and modifications to the transaction documents, and it's really on a case by case basis. But documents themselves aren't changing as much as the difficulty in getting a loan approved and processed.
Yeah, their due diligence is much more strenuous now, and they have COVID certifications that they want filled out, but the documents really haven't changed. I agree with Bill.
Great, thanks. So some of the audience questions: what are the factors we need to consider to enter a partnership with another partner who is also a provider? So entering a partnership with a partner who is also a provider.
So is that like, I'm just trying to clarify that. I think what they're talking about maybe is two people maybe starting a practice together. Is that?
I take it that as well.
Okay. Yeah. So, well, that's very interesting. When you start a practice together from scratch, as much as anything else, you really have to be on the same page, not only in terms of culture, fit, and philosophy. And when I say that, I'll give some examples. If you have one doctor who's incredibly technology driven, right? Maybe they're using CERAC, they're doing laser dentistry, and maybe you have another partner who doesn't have the same belief system on the use of technology. That's when I talk about like fit and philosophy. Those are things that people don't necessarily think about in advance, but you have to think about that. How about managing people? There's some people who manage by policy and they're much more structured. And then you have other people who manage very much by emotion and kind of off the cuff. So the first piece of it really is making sure that you choose wisely, and that you also pick someone that complements you in practice. Maybe there's certain types of procedures that one person can do that the other can't. Again, just making up an example. Maybe somebody can do great work on implants and the other doctor can't, but they have other strengths. Trying to find that right combination of person is very important. And then the other piece of it is the same vision and the same work ethic. And going back to that story before, having the parties agree to minimum standards and commitments to the practice. These are all things that you want to flush out in advance, especially if you haven't had the chance to work together.
Great, thank you. Next question. If I am a dentist who wants to own a practice, but not work in the practice as much due to other business ventures. So if I am a dentist who wants to own a practice but not work in it, have an associate and team, what recommendations do you have to make this happen? Would you recommend to work in the office initially or find an associate from the beginning?
Well, that's a very good question. I think that initially you want to stabilize a practice or make sure that you get the practice running the way you need it to run. And I think that if you're not acquiring a practice and retaining the practitioner for a period of time, I don't see as how you avoid working in it. In fact, I had a client years ago who got himself in a lot of trouble financially and ultimately bankrupt because he acquired a practice. The doctor wasn't going to stay on and was very upfront about the fact that he was going to give a 90-day transition and that was going to be it. And there was no continuity in this practice. And the client tried to just throw an associate in there and it became a revolving door of associates. And then eventually the patient base just started to disperse because there was no consistency there. So at some point you have to stabilize the practice and you have to groom someone the right way. Ideally, if you have a seller that stays on long term, it's a much easier process, which is why, for example, when DSOs are making acquisitions, right? What's one of the big requirements a lot of times in most deals is the seller's staying on for 3 to 5 year contract. That's not on accident, right? So, that's why also we talked about when you're scaling and you're going and you want to be a CEO dentist and you don't want to be turning a handpiece in every location. That's the concept of having those minority working partners. If you can find the right people, a partner is going to be far more vested in that location than an associate. Sometimes it's worth giving up a piece in order to be able to have the continuity and then allow you to scale to yet another practice and another one. I mean, we have clients that have, several practices and many of which they spend very little time in, but they've got that continuity. They either have the former seller or who stayed on, they have a minority partner, they've got continuity and it's not a revolving door of associates.
Yeah, you're really spot on because the patients will notice. And patients notice a lot more than we think they do.
Yeah, this practice, the one I'm speaking of that I gave the hypothetical where it ultimately, literally went down to nothing. It had been a dental practice like multi-generation. It was doing about $1.3 million when it was acquired. And when it finally closed its doors, it was down to like a $240,000 gross. I mean, talk about dismantling a great practice, but the problem was there was just no continuity there, and it was a revolving door.
Yeah, can you talk about a situation? And I know this in my community. Do you have any advice about parent and child when the child who is a dentist comes into the family practice? When should they structure an agreement, talk about buy, sell, about equity? Have you experienced those issues?
Yes.
many times.
Yes. Many, as Casey says, many times. So that's always a tricky one, and there's a lot of parent-child practices out there. Many, dentistry is one of those great professions where a lot of times children do follow in mom or dad's footsteps. I think that, there's good arguments to be made too, that when someone is in the beginning of their career, sometimes it's not a bad idea, even if the ultimate goal is that they're going to join the practice, it's not a bad idea for them to maybe get in with a great practice and a great mentor somewhere else and maybe, have an experience elsewhere. But even when they don't, communication is, and I hate to sound like a psychiatrist, but communication is so important. And each party, parent, child, understanding the expectations of the other is significant. And a lot of times too, with a lot of our clients, the dental practice itself represents often the most valuable asset, that the doctor has. So, parents are sometimes in a tough situation where when they want to transition to the next generation, not that sometimes they just, they really can't give it away. And especially if it's something they were counting on for retirement, they may even need to get like a full fair market value for it. So right. Communication, go ahead, I'm sorry.
Yeah, no, because the one bitter kind of story I know, not from my work capacity, is the seller, the senior dentist said, I need maximum value because one, it's my nest egg, my retirement. And I have 3 kids. You're one that eventually I want to leave money equally to. And if I give you this practice, I'm really not leaving other money to the other 2 eventually.
That's right. And that does happen. And but what I say to the young doctors out there though, who, look, children are, it's sometimes hard, no matter how smart they may be and how much older they get, sometimes it's hard for them to digest that mom or dad, really needs to maximize the value of this asset. But what I say to the younger doctors is your ability to transition a practice that was your parents' is so far superior to that of somebody cold off the street, in my opinion, that the practice is actually worth more to you than it would be to somebody off the street. If you really think about it, it's okay if mom or dad has made tons of money and they're in a great spot and they don't have those other complications, whether it's with siblings or what have you, and they are able to give it to you or give it to you at a discount. It's great. That's wonderful. We come up with creative ways to structure that. But if that's not the case, it shouldn't really deter a young doctor from moving forward, because most of the deals that I've seen over the years have actually gone quite well. And there's one that pops into mind with a father-son duo that we've represented for a long time. And they really went through ups and downs, learning, figuring each other out, but they kept at it. And they really got to a place where they realized what each of them loved to do. And they were actually different things. And dad realized that his son was a really terrific young business person and had tremendous ideas on marketing and how to build the practice. And dad realized that even though he had built a very successful practice, he really just liked doing great high-end dentistry. And what they kind of figured each other out. And, fast forward, they've tripled the size of the practice. It's about a $6 or $7 million a year practice now. And it's a great story of how, father and son figured it out and have gotten to a really great place. So I encourage those deals. I found that they've ended up much more positive than negative throughout my career. So maybe I've been lucky, but that's how it's worked.
And we're also very cautious. Sorry, Keith, I just wanted to add here. Whenever we're working with a family, we're always super cautious about the personal relationship behind the business. And I think, the sensitivity to that, to make sure that the documents kind of contemplate everything, that we keep it very, it's a business relationship, but we're very aware of the fact that there's the family dynamic. And I think we're being sensitive to that is important. Great.
We have 2 more questions, well, at least, but we'll just do 2 from the audience because I am going to tell people about, how they can ask questions after. How would you structure a chart sale? And I think in this, these chaotic times, there are a lot of smaller practices, offering up chart sales that were either struggling before COVID or very part-time, and a chart sale is the right solution. So how do you structure a chart sale?
Yeah, we're doing several of those a week right now. I mean, that's how prevalent they are, just because some of the more senior dentists are just not interested in continuing to operate their practice. I will tell you that the bulk of them right now we're doing as earnouts, because there's, a lot of times the practice has been closed for several weeks. It's not operating at maximum capacity. And so we're just not really sure how to value it. And because of that, a lot of people are willing to do the earnout deal. So basically the way that works is that the purchase price is based on a percentage of revenue derived from that specific patient base on an ongoing basis, typically either 3 to 5 years. And like Bill mentioned before, sometimes there's a cash payment right at closing as an advance to pay off any debts, broker fees, et cetera. And then the rest of it gets paid over time.
Yeah, but the other way to do it, and when we're representing buyers, if they're in a strong bargaining position, they can really simply buy, for a very low price, they can buy the charts, the phone number. We usually, do it in a simple way. It's usually they're buying the phone number, the fax number, the website domain, if one exists, and the charts. And it's basically like a little mini asset sale of just the charts. And, look, nobody likes to take advantage of someone's difficult situation, but, the market is a market. And, sometimes, those chart sales can take place for a very nominal amount of money in a lump sum. It's better if either A, the buyer doesn't want to lay out any cash at all and would rather do the earnout. It's great. The earnout on a chart sale usually ends up working very well for a seller. The irony is that buyers are usually more willing to do it in a chart sale, and for some reason sellers are more reluctant. But if you think about it, the result usually ends up being better for the seller, because most entrepreneurial, growth-oriented buyers are going to take those charts. They're going to get into a serious plan of reactivation, and they're going to try to supercharge what they bought, and ultimately put a lot of those patients back on the books. So, in the end, I think that the seller actually does better with an earnout on a chart sale. But it can be structured either way.
Yep. Thank you. And how do we? It's funny. We're ending back on a family question. How do we structure ownership, and for family members who aren't dentists in states who only recognize ownership by dentists?
That's a very good question.
Yeah.
And that tees us up great for the next seminar that we're going to do.
I was going to say, that's a whole seminar.
Setting up your own private DSO, because really that's the way to do it. If you want to be able to get non-licensed people into the business or profession of dentistry through management, and be in a position where, in compliance with the healthcare regulations in their particular state, those people can earn money through a practice and through the dentistry that's provided. The way to do that is to organize a DSO and have agreements between the practice entity and the DSO, so that they're able to be able to participate in management and in running the business, and ultimately profiting from the revenue derived from that practice.
Right. And that's why dental specific attorneys like you two are, this is your day job, and you're very experienced and very good at it. And when you said getting the right team, you make such a difference. And because if people have to unravel or end up, with, penalties and reputation risk, it could all be avoided.
Yeah. Well, thanks, Keith. And you're spot on with that. I mean, using the DSO as an example, I mean, Casey and I work on them with our healthcare regulatory team all over the United States. I mean, we've just recently done them we just did one in Idaho, Texas, New York, Florida, Connecticut. I mean, we've done them in, I don't know if all 50 states at this point, but probably pretty.
Not quite. We're in the 40s.
Yeah, we're getting there. We're close. And every state is different. And that's why it's, I was jokingly saying how that's another seminar for down the road.
Sure.
In every state, what you can and can't do in the structure of a DSO varies, and you have to understand the regulations in those states and be able to set the agreements up properly. But it's very doable, and it's a great question. I'm glad that it was
right, because we're geographically, even though we're on our computers, we're not that far away from each other. I'm in New York, you're in New Jersey, but the laws are very different in those two states, and you would do things differently.
That's right.
So, great. This is really very informative, very relevant. So thank you. Thank you, everybody, for attending tonight's webinar. If you have additional questions, please email us at webinars@henryschein.com. You can see Bill's contact info on the screen. Actually, everybody tonight attending will receive a link to the recorded presentation next week via email. On behalf of the Henry Schein Business Dental Institute, I'd like to thank our speakers for their time and thank you all for attending and wish you a good evening or good afternoon on the West Coast. And thank you very much.